As the federal student loan payment pause officially comes to an end, it's important to take inventory of what your monthly payment will be if you have a Parent Plus loan. Even more important is to make sure that you are staying on track for retirement now that these payments are beginning to resume. Today, we're going to discuss the things that you should be aware of as you plan for both retirement and repaying that Parent Plus loan. What's going on, everybody? I'm Danny Sinowitz, the college dude. If you haven't yet, be sure to subscribe to my channel for more great content when it comes to paying for college and things such as Parent Plus loans and student loans in general. Also, be sure to give this page a like and to make sure to share this video if you found it to be useful. So if you aren't aware by now, Parent Plus loans are part of the federal loan system. They're issued directly by the Department of Education, and they're repaid at one of the different servicers that the federal government utilizes and have certain protections in place through the federal student loan system, such as the ability to potentially get into an income-driven repayment plan, the ability to qualify for public service loan forgiveness, and some things like you just would have seen, the COVID forbearance that has taken place over the last 2.5 years. Now that that's going to be ending, we want to make sure that if you are planning to make repayments, that you are on the best strategy possible while staying on track for retirement. So many parents, when they took out Parent Plus loans, were not aware of the overall balance that they could be facing, and many were not aware of the repayment strategies. So it could come as a surprise in terms of how much you actually need to repay on a monthly basis. One thing that we're going to discuss today is to make sure that if you're making these repayments, that you're able to afford them monthly, but also stay on track for retirement. So what you may or may not be aware of is that there are a number of different repayment plans available to Parent Plus loan borrowers. The two most common that are out there are the standard and the graduated repayments. These payments typically are in place in case the parent has not done any type of research into an income-driven repayment plan. So for example, the standard payment is just going to be a 10-year payment in which the average interest is going to be amortized over that time period and repaid on the same monthly amount each month until after the 10 years when it's paid off. The graduated repayment, though, the first couple of years, those repayments are going to be less than they would be in the last couple of years. So every 2 years, that graduated repayment starts to creep up, and you would pay more interest over the life of this loan, but it is a way that you can also be a little bit more flexible in some of the ways in which to budget. However, some of the more popular ways to repay Parent Plus loans are through the federal income-driven repayment plans. The first way in which you should be considering to get on any of the income-driven repayment plans is the double consolidation strategy, which we did a video on a couple of weeks ago. There is currently some debate right now if this strategy still is active and still exists. However, what we do know at a minimum is that you are also eligible for the income contingent repayment plan. So assuming that the double loan consolidation strategy is still in place, that's one in which you can get on any repayment plan. Your other option is to get onto the income contingent repayment plan. It's important to distinguish between the differences, and again, you can check that out in the video that we linked. But in terms of understanding how this works, is it is going to be tied to the amount of income that the Parent Plus loan borrower has in his or her name. Parent Plus loans are only taken out in one parent's name. They can't be taken out in both parents' names. So when it comes to some of the tax strategies that you should be considering, the things that you want to be looking into are A, does the parent access the public forgiveness? The other thing to consider is how much they're actually bringing in on an actual monthly basis and an annual basis, because that's also going to determine the amount that needs to be repaid. So if it's under the amount of the standard repayment and you can stretch that amount over a 10-year time period and potentially qualify for public service loan forgiveness, you can qualify for a great benefit. The other thing that you need to keep in mind, though, is that there are standard forgiveness options available. So if you're on the income contingent repayment plan, after 25 years of repayments, those can eventually be forgiven. Now, there are some taxable implications with that currently, and some of these things are going to be subject to change over the next 25 years that we wouldn't be aware of. But as the rules are written today, that forgiven amount would be considered taxable. So the amount that's forgiven would show up on the tax return as taxable income, and you would owe a percentage of that income in a taxable payment. Why that's important is you now want to figure out what this monthly payment will likely look at each month. That way you can actually compare that to how much you've saved for retirement and what your monthly cash flow coming in will look like. Unfortunately, in retirement, some parents do carry some debt along with them. If that's the case, you're going to need to budget accordingly for that. So, by making sure that you are on a lower repayment plan or one that would be tied to income, as opposed to a higher repayment plan, which may only be spread out over 10 years, that can allow you to have more cash flow in the budget. Each plan is going to vary based on the amount of income that the parents are bringing in, their tax filing status, their household size, and how much the actual amount is that they've taken and loaned out. It also might depend if you are eligible for public service loan forgiveness. So these are the factors that you want to be considering. When it comes to retirement planning, though, you want to make sure that you have a plan in place to turn assets into income. Some parents are going to be in a position where they may have a pension. They may have a public service job which provides a pension to them. Many folks are going to be eligible for Social Security as well. Both Social Security and pensions, so long as the system that's withholding it stays intact, should provide a guaranteed paycheck for life. Each system, though, is going to vary, so make sure that you understand the credit system of the pension provider that you have. But after Social Security and pensions are accounted for, usually the next thing that we need to look at is how much you actually have saved up for your retirement. So this is where a lot of folks tend to have dollars in something like a 401k, like a Roth IRA, etc. Turning these assets into income becomes important in retirement because having this type of income plan will allow you then to determine how much you can be taking out on a safe basis, but then still be paying on those Parent Plus loans. There are two big things that you should be considering, and this is where tax planning becomes super important if you have a Parent Plus loan in retirement. The first thing that you should be considering is if you're currently still working and planning to retire and have a Parent Plus loan, there are accounts that you can actually contribute to for your retirement that will lower the adjusted gross income and in turn lower the payments on an income-driven repayment plan. So if you're on an income-driven repayment plan, what the provider is going to be looking at is your adjusted gross income. The less that you make in terms of your adjusted gross income, the less that you actually have to repay on a monthly basis. By making less on your tax return, you're able then to make less of a monthly payment. If you're contributing things like a 401k, like an IRA or an HSA, things that can get you a pre-tax deduction, this can in turn lower the monthly payment that you have on student loan payments, thus creating a positive effect on both the monthly repayments, but also in your retirement savings. The other thing to keep in mind is if you're actually in retirement, one of the strategies that you can utilize is after-tax accounts to supplement some of the income. So if you have a Roth IRA or you have an after-tax account that has a significant cost basis to it, what you're able to then look at is to take from these accounts, coordinating these to actually use as income. Therefore, you don't necessarily need to report some of those tax return to raise your adjusted gross income. Now, these accounts will vary. It doesn't necessarily mean that this is a simple strategy that you don't have to do any planning for, but instead, what you can be looking at is what type of the accounts that you have that are after tax that you can start to utilize as income. By utilizing these as income, if you have a lower adjusted gross income, your Parent Plus loan repayment will also be lower as a result if you're on an income-driven repayment plan. So if you have some of these savings built up and you're able to utilize these, this can lower the amount that you have to repay and also increase the amount that would you be eligible for in terms of forgiveness. Debt planning, insurance planning, retirement planning, investment planning, and tax planning, they oftentimes are all going to be interrelated. You need to make sure that you are working with a professional to help you actually make these repayments. By doing so, it can provide you with a better understanding of lowering monthly payments while at the same time increasing retirement savings. The ultimate goal, when all is said and done, should be that your goals are being achieved. To get there, sometimes you may need some help, but you also need to understand how these different accounts work and how the repayment plans work. By having these plans working in conjunction, you can maximize your plan for efficiency. As always, this information is meant to be educational in nature, and none of this information is meant to be specific advice to any one individual. If you have any questions, make sure that you are reaching out to your CPA or your tax preparer, your financial planner, your tax attorney, and anybody else who's helping you, whether it be related to student loan repayments or whether it be related to planning out your retirement. If you haven't yet, check out www.thecollegedude.com for more information on ways to save for college and best repay. Until next time.